The turtle soup, a trading concept popularized by ICT, is one of the easiest trading strategies that both beginners and advanced traders can profit from. Let's learn it to be able to apply it on our trading plan. The turtle soup, despite its funny and confusing name, is simply just a false breakout pattern in ICT and smart money concepts. The false breakouts are important to identify where is liquidity situated. That in itself helps us in avoiding getting trapped, and as well as being able to follow the footsteps of the smart money. So you see, we have, for example, this range, and it could be in range, it could be only highs and lows. So let's say we have this range, we have this swing high, and this swing low, and the continuation of the price action is situated inside the range. So what that means is that the price yet does not break the swing high and does not break the swing low. So a lot of traders, what they are usually looking to be doing is looking for a breakout in any of those swing highs or swing lows. So anytime the price goes above the swing high or below the swing low, what they're considering and waiting for is a breakout either to the upside or to the downside. So anytime price goes above the swing high, they're going buy long with a limit order here or buy stop. They expect and want the price to continue going up. But in reality, what actually happens most of the time is, if we have a range before the real breakout happens, what's going to happen is a manipulation. So if the range wants to go higher, so if the real breakout is going to be to the upside, and what's going to happen here is price taking this range low, sweeping below, manipulating and convincing people to enter sell shorts, and then going up. What's going to happen here is people who are having sell stops, the order is being filled, price goes lower, stop loss above this, and they lose the trade because the prices comes back into the range. Some traders are also using more basic trading tactics like support and resistance, for example, and they are entering buy longs from here, and they also lost. People who are entering short, they also lose. So both traders that are selling shorting and buying long here are losing. So in this video, we are going to learn how to properly trade this situation. You see, after this manipulation, the direction is very clear, which is to the upside and to the swing high. So what we're trying to do here is enter the trade at the best opportunity we can get here, or in the worst case, after the manipulation. So just keep in mind that the whole turtle soup strategy is just a false breakout setup. I tell you that because a lot of traders make it more complicated than it actually is. Now there is an easier way of applying this strategy, and it's based on trading during session highs and lows. However, it comes with a downside. The disadvantage being we are going to have fewer setups. It is not 100% needed to trade turtle soups during session highs and lows. You can also identify highs and lows with great impact on price action. Levels that play an important role in moving liquidity. You identify these levels with experience. But we're going to talk about them on the charts anyway. Opening price. This is the way we are going to plan the entry for the setup. So what you're looking for is this is a bearish case, and this is a bullish case. What we want to see is a clear liquidity sweep. Here you can see that price is not closing above, and instead it just wicks above and comes back down. And we have this candle closing here. Keep in mind that the closing price of this bullish candle is actually the opening price of the next candle. So any closing price of any candle is the open price of the next candle. It's the fundamentals of the Japanese candlesticks. So this candle closes here. That means that the open of the next candle is the close of the previous candle. And on the bullish scenario, the first candle closes here. That means that the second candle open is this, which corresponds to the close of the previous candle. So if we see a sweep of the levels, we mark the open of the candle, and I will explain on the charts how to approach this strategy for setups. But an important detail is that we do not want a full body closure. This strategy is more validated when candle body is small and has large wicks, because it indicates a sweep of liquidity. But keep in mind that we want this only for the first candle. On the second one, we are looking for a fuller body candle as confirmation that the momentum is increasing towards our side. And on the bullish scenario similarly, wick for the liquidity sweep. The next details we are going to cover are the steps to validate a high-quality turtle soup setup. The first one is marking session highs and session lows. That is if you trade the session range. You can also trade swing liquidity levels that are outside the session range. But, as I mentioned before, trading the volatility of the session high and low will give you less trades, but more qualitative valid setups. And if you choose not to do it, you can trade swing liquidity levels if you have the skills to identify those levels. And you might find out that you are going to have many more setups, but a little less valid ones with lower quality. It is also preferred if you look for points of interest near those highs and lows. The points of interest can be fair value gaps, order blocks, supply and demand zones, and so on, and then we wait for price to sweep those highs and lows, which is step number 2. Ideally, the liquidity sweep should be done with a wick and not with a full body closure above the range. The wick shows that whoever and whatever manipulated the market, it did not close with a full body, and that's for a good reason. Mostly because they just took the liquidity from the opposite side traders. If they were looking for continuation, the candle will close with a fuller and larger body, which shows the increase of interest, volume, and momentum to keep pushing the price to the main direction. And then what we're going to do is mark the closing price of that rejection candle, mark the high of the candle body when bearish, and mark the low of the candle bod when bullish. So what we are focusing on is not the candle wicks. The wicks confirm that we may have rejection, but then the candle bodies tells us where to go buy long from, or where to go sell short from. So we're going to be marking the body high if bearish, and body low if bullish. And then for the next step, we are going to look for candle body closures above or below the opening levels in the lower time frames. And then for the last step, we are opening the orders, and then we're going to be targeting the next swing liquidity, high or low, or you could even look for the sessions levels. So the previous session highs and lows, or if you're entering on the London session, there is an often met sweep of the Asian low that later we can use that to target the Asian highs. All of these steps are going to be used and explained during the charting analysis. These are pretty easy steps to identify and follow. It's almost like a straight to the point because only the first step is slightly more complicated since it has some level of subjectivity. First, let's look at an already done setup to make sure you understand the main points, from which we move into live testing the strategy. If we enable the trading sessions indicator, the yellow rectangle represents the Asia session. The start of the rectangle is the Asian open. The end of the yellow zone is the Asian session close. The start of the green zone is the London session open. The end of the green zone is the close of the London session. Usually, a very popular trading strategy is the counter-trading parity of the Asian session with the London session. You will often see that London takes the maximum high or maximum low of the Asian session, so it takes the liquidity from those levels and reverts the trend into the opposite side. And if we apply the turtle soup strategy on the Asian session using this knowledge, we identify and mark the Asia session high and the Asia session low, and we can see how inside the London session, the price first takes out the liquidity of the Asia session lows and pushes the price to the upside, breaking the consolidation that the Asia range has set, by finally breaking the highs that have been set on the previous session being the Asia. And if we ask, why did the liquidity sweep first happen to the lows by breaking the lows? And we can answer that by looking at an entry model. The entry model in this chart is the following demand zone. Entry models show where the smart money, or more simply explained, where the large orders are placed, showing an interest of where they want to move the market. And of course, from a demand zone, buy long orders are being placed. On another charting example, this time on the Nasdaq in the 15-minute time frame, let's analyze the market. This market follows a clear uptrend currently, with easy-to-observe higher highs. So far, each higher low had a bullish order block to it as validation. On a bullish order block, the entry setup is simple, placing buy orders at the top of the zone, with stop loss below the zone, and take profit above the last swing highs. Very simple setup that I'm sure many smart money traders took. The price broke the last swing highs, creating a bullish break of structure, and that validates a new bullish order block created from the last lower high. And if we look in the past, there is even a more external order block, so this would actually be the main one. And internally, we also got one here, validated by an internal change of character. So as expect, what the price does is mitigate the order block to continue the price higher. This itself forms a new bullish break of structure. So now we can remove the past two order blocks, the upper mitigated one because it already has been filled, and the one lower to it because it invalidated as the orders that triggered the trend continuation to break the highs was the internal bullish order block. So the price goes down aggressively afterwards. Since we have entered a higher time frame consolidation, this is where the turtle soup plan comes in. The price firstly broke the high, but it did close above the range. Closure above the range means higher chances for continuation, which is why I mentioned that it is really important for the zone to firstly get broken by wicks and show an instant rejection, which in this case is not valid. Sure, a short would have worked from the top, but it's easy to say now that we already can see what happened, and sell shorting from there plays against the plan of following the main trend. The current main trend is an uptrend, so if we take the low of the range, we can see that it wicked right below, indicative for being a liquidity sweep. But in this case, we have an extra confirmation, and that is the unmitigated bullish order block that was situated in the most external structure. And the candle instantly rejects to the upside right after filling of the zone. So this being a great setup. Buy long, stop loss below, take profit above the last range high. And that was it. Basically just continuing the main high time frame trend. It's very important to analyze the trend and trade with it. The most effective trading strategies follow the trend instead of trading against it. Jumping into another already done setup. Just like the first time we are using the sessions indicator. In the previous setup, we used the swing high and swing low scenario. It usually is more difficult that way because the levels can get slightly subjective. But by using the sessions, it's always going to be the same strategy mechanically. So, as a quick recap on this simple strategy, we mark the high of the Asia session and low of the Asia session. We can see that it first broke the Asia high and did not close. So it just wicked above and instantly rejected, making it a valid liquidity sweep scenario. And what happened shortly after, we can see a huge push to the downside. So remember the strategy. First liquidity sweep to the upside. Look for sell shorts to take the price down below the swing low. And if the first liquidity sweep is to the downside, look for buy long opportunities to take the price up above the swing high. In this time frame, we did not have any significant entry model for the sell short, but if we move into a lower time frame, we should be able to identify, doing the analysis on the higher time frame and moving to a lower time frame for the execution is an advanced smart money concept that can be applied to all trading strategies into the 5-minute time frame. There is a small bearish fair value gap. And we can see that the sell short would have worked with a great risk to reward ratio. There is also the possibility to move into an even lower time frame, let's say the 1-minute one. And here's also a small fair value gap, however a lower quality one. And both setups provide a similar risk to reward ratio. I usually do not switch to such a low time frame. There are two main types of the turtle soups. The main one, which is what we have been using so far, is named the continuation turtle soup. This price represents the high time frame trend. If we look at the macro swing levels, the market is under a high time frame consolidation. But if we look at the micro internal levels, the market starts in an uptrend and ends up reversing into a downtrend. The continuation turtle soup essentially says that we prioritize the liquidity sweeps that respect the trend that the market is currently following. So if we look at the first part, when there was an uptrend, the liquidity sweeps that we look for are not internal highs. For example, this is an internal high, and the following are also internal highs. It does not make sense to look for the price go break to the upside and look for the turtle soup setup to take out the swing lows. What the continuation turtle soup model says is to look for liquidity sweeps to the downside in an uptrend. So for example, this is how this entire price action looks like on a lower time frame. The start is from here to here. So the price first breaks the swing low with a wick and instantly recovers to the upside. Following the continuation turtle soup model, we now look for bullish points of interest to take the price to the highs, basically continuing the main trend, which is a bullish one. Coming back into the higher time frame price action, At some point, the market will reverse and the main trend becomes a downtrend. That is usually done because price hits a high time frame point of interest, like an order block, a supply zone, or a fair value gap. These models' intentions are to take the price down, create a market structure shift from which price pulls back up and confirms a downtrend by not being able to break the last swing high, and instead breaking the last lows. So right now, the market has entered a downtrend. In a downtrend, applying the turtle soup continuation model. We look for liquidity sweeps inside the lower time frame of the pullback. So for example, this price action is minimized into a lower time frame, and it should look like this. Low time frame consolidation. The buying momentum increases, which drives the price up, sweeps liquidity, and instantly breaks below the last lows. And a small tip to remember correctly, the liquidity sweeps happen opposite to the breaks of structure corresponding to both trends. On uptrends, the opposite of the break of structure is the liquidity sweep, and the opposite on main downtrends. The second type of turtle soup is the reversal turtle soup model. The reversal model is much harder, and I rarely trade using it. It uses the same price action movement, but the setup plan is different. Now, instead of wanting to catch multiple smaller setups in the micro trend, just like in the continuation model, but on the reversal model, we look to catch the tip of the top in just one big trade. So that means that when the price is at this level, and we zoom into the lower time frame, we trade against the macro trend. So it's about predicting that price will go up and break, just like it did before. But this time, it will not continue the main uptrend, and instead, it will break to the downside. This setup gives you a very high risk to reward ratio in just one big trade, but it is extremely difficult, and this reversal model might not be suitable for 90% of traders that use the turtle soup strategy. The difficulty comes simply because you see an uptrend on the higher time frame and you decide to sell short it, basically trying to time the tops and trade against the trend. If we see this kind of setup on the charts, I will mention it. However, there are rare setups to find. Jumping into another chart backtest. First, we need to analyze how this market has moved, so we can understand the trend and the most probable upcoming price action. From the left, we can see a huge downturn red candle, considering that we initially were in a downtrend. This move breaks structure into continuation of the downtrend. The upcoming downtrend is shortly lived because the market starts pushing towards the upside, managing to break the initial aggressive downturn candle. And this becomes a bullish change of character or a market structure shift from a bearish standpoint to a bullish standpoint. So on the 15-minute time frame, we have entered an uptrend. The uptrend continues, being validated by upcoming bullish breaks of structure. It is only at this point where the price internally breaks the low. However, not that important since the market pulled back. And instead of breaking to the downside, it created a higher low and broke the major highs. So basically, it did not manage to reverse into a downtrend and instead continue the uptrend. If we observe, we have a demand zone from where price has bounced up each time it has moved into the zone, without breaking it down. From this demand zone, we can also see how each upcoming swing low was higher than the previous ones. This indicates two things. Sellers are losing control, and buyers are taking over. There was also an internal bullish break of structure. However, this was useful for us, more so for the traders that were having setups in mind there on a lower time frame. And we came at the end of the analysis. Applying the turtle soup model, we identify the high and the low and we wait for one side to break. Since we are in an uptrend, applying the continuation turtle soup model, the price should break down just to break up afterwards. If it doesn't, we don't take the trade because it means that we would trade against the trend. The market broke the low, which is what we want to see. But more interesting, look where it bounced from. Exactly on the demand zone. So it swept liquidity below the lows, just to bounce back into the range. This gives traders multiple buying opportunities, with a very high risk to reward ratio. However, we do not need such high risk to reward. We would take partials and set stop loss to entry to be safer, and the other way is to switch to a lower time frame. Identify an entry model, as example the following fair value gap on the smaller time frame, and place a buy long order. The take profits and stop loss can be dynamic. We can place it below the gap or below the demand. And it broke the highs, continued the main uptrend. Level where the trade has closed with a take profit. Very simple, just identifying setups and trading with the main trend. If you liked the video, we have a detailed trading mastermind on the description of the video, and it also includes a short and easy to understand psychology ebook. Thank you for watching and have great trades.